Hi, everyone. Welcome to the Small Cap Discoveries Conference call. Today on our call, we have back the CEO, Rene Goehrum from BioSyent. BioSyent trades on the TSX Venture Exchange under the symbol RX. The company is currently trading at $8.45 with about 12 million shares outstanding, or about $101 million market cap. I'd now like to hand it over to Paul Andrilla.
Hey, thanks a lot, Trevor. I'm pretty excited to have Rene back. We just were talking about this. It's been almost 3 years since we saw you last, Rene. That's far too long. And the reason I'm partly excited is I mean, the BioSyent's a great company. I think we've spoken about it a number of times in the past. But I also view Rene as sort of I call it the Hall of Fame inductee as far as microcaps, Canadian microcaps. It's been a long journey to get to where you are now. Certainly when I first met you, business wasn't in this shape. So to go from where you were to where you are now, hats off to you. You've done a spectacular job, and a lot of shareholders obviously pretty pleased about it. So again, happy to have you here. Great to hear an update on the story. But before we sort of get into any kind of updates, important for especially the new people here that don't know the BioSyent story very well, maybe let's jump into it. Let's tell everybody what it's all about. You got your slide deck, so I'm going to hand it over to you.
Great, thanks, Paul. I'm happy to be back with you, and I guess we're just short of 3 years since we last did one of these. I've got a couple of slides to kind of walk your group through, and then I guess some Q&A. So let's fire away. As I always like to just remind folks that we have a forward-looking statements disclaimer. Just kind of dive into the business itself. So BioSyent is a Toronto, Canada-based specialty pharmaceutical company. We look for unique and differentiated products that solve a medical problem or address an unmet need or do something better than an existing therapy or product in the marketplace. We in-license those products or acquire them for commercialization in Canada. We source globally. Our deals have been Europe, US, Australia. We've worked, haven't consummated anything, but we've worked with some potential Japanese partners. So we're agnostic as to where the technology or the product comes from. What's important is that it's a win-win deal that we think can provide value to the Canadian healthcare marketplace, and that provides a good return for our shareholders. We focus primarily on products that are late stage, so they're typically already in market somewhere in their home country or somewhere else, but they may still be. We've of late looked at more phase 3 type products that are not yet fully ready for market, though we have not got any of those in our portfolio. We do measured R&D and investing. That is, that we don't really develop the products. We work with companies that have already developed the products and have taken it through that kind of risky part. So there's really, one slide in my deck here that matters. This is the one. We have a track record of profitable growth. Our trailing 12 months to last September. That's our last disclosed quarter. Of course, our fiscal is December 31st, but we won't be talking about the fourth quarter today. So on a TTM basis, just under 31 million in revenue, EBITDA just under 8 million, EPS of 50 cents, and a return on equity of 18%. We've built a scalable platform. Paul made reference to it in the intro. We've been at this for a while. We've got a national sales force. In fact, we have 3 sales teams, one larger sales force, and then a couple of small specialty teams for certain products. We've got 10 pharmaceutical products approved for the Canadian market. 3 of those products were introduced in 2023. And our assessment of our portfolio, that is all assets that we have either in-licensed or that we own. So not a deal that we might do in the future, but products that we can wrap our arms around today, support approximately $60 million in peak penetration revenue. We've got a strong balance sheet. We have no debt, $29 million in cash as of September 30th. We've been buying back shares for 5 years now. We've reduced our fully diluted shares by 18% over that period of time. And in fact, we took an extra step to change our equity incentive compensation for leaders in the business away from share options. We haven't issued a share option now going back, I think it's 3.5 years. We've gone to RSUs, and you might say, well, RSUs can be dilutive, and indeed they could be. But the way we do it is we go into the open market and we buy BioSyent shares. We hold them in trust so that we can satisfy our obligations under the RSU. So there's been zero dilution of any sort in terms of new issue of instrument if we're just about 4 years into it now. We've got an experienced management team, on average tenure of around 11 years, and we're owners. We own 25% of the company as insiders, so between the board and management, and then if I added to that retired management, literally their last real job was working at BioSyent and now retired and been with us for quite a long time. That ownership percentage touches close to 40% of the company in very tight hands. So this is what 13 years of profitable growth looks like. We came profitable at the second quarter of 2010. You'll note that on this slide that we are showing through to 2022 on revenue. Obviously, I just spoke about TTM to September 30th, so track through the $30 million mark. Something happened in the fourth quarter that should shake that. Back in 2010, when we came profitable, we had two products. We had our legacy business, and we had Feramax, literally in the very early days. And now we have all of those products you see on the right-hand side of the slide. And then at the very bottom of your screen on the left-hand side, you can see that we had 14.3 million shares fully diluted back in 2010. And as we've built the business, we have reduced the share count considerably over that period of time, which I've already spoken about. So our last reported quarter, for some of you, this may be new news, but it isn't really new because it was disclosed in November. Our top line grew in the quarter by 31%, and it's strong earnings, both on a measured on EBITDA and net income after tax. Largely driven by a very large international Feramax order, but also strong performance in our Canadian pharmaceutical business. If you take a look at how the business has done through 9 months of last year, up 14%. Once again, the Canadian pharmaceutical business up in that range, same number, 14%, and strong performance on our EBITDA and net income after tax basis. So just a quick look at our EPS, and you can see to a certain extent a little bit of what's happening. One thing, 53 consecutive quarters of profitability, so that takes us all the way back to that second quarter of 2010, and we've made money every quarter since then. And then you see recap there, the last reported quarter, Q3, was 20 cents. Bit of an outlier in that group, and that was driven by that strong pharmaceutical performance in the quarter. But we're now at over 50 cents in terms of EPS, and we have a stronger earnings per share performance than we do net income after tax because we've been consistently buying back our shares as well. So a couple of things to highlight. We're now kind of into the what's new with the story, what's going on. We launched Feramax 45 in March. I'll speak about Feramax 45 in a couple of slides. Feramax, the brand, was named the #1 recommended oral iron supplement for the 8th year in a row. We launched a new Inofolic, a women's health product for PCOS. That was launched and started shipping in August. We extended our Cathogel agreement with our partner out to 2034. That was expiring, I believe it was to be expiring this year, and that was pushed out to 2034. Our partner's quite satisfied with our business performance on that product, and we've been commercializing that product in Canada. I think this is the second extension. We first started shipping in 2012. We launched a resource for women that are going through menopause. It's an important part of our business. We have a product, Tabella is the brand name for women with menopause. So we launched menopausinformation.ca. Got that up with the support of healthcare professionals and endorsement from important the Menopause Society and the SOGC, Society of Obstetrics and Gynecology. In November, we announced new Gelclair. Well, we've been talking about it before then, but we started shipping Gelclair, which is an oncology supportive care product. During the course of the year, we paid 16 cents per share in dividends. So we initiated a dividend program a year ago, December, so December of 22. We've now made 5 dividend payments starting in December of 22, and so the 16 cents is just for fiscal year 2023. Excuse me. During the year, we bought back just over 1,000 shares. So when we announce NCIB, we don't just kind of put it out there. We actually put our money. So I've already talked about Feramax being the #1 recommended. This is an independent survey that's done amongst pharmacists and physicians. So 8 consecutive years. I'll just speak a little bit about what we've been doing with Feramax. It is our largest revenue product. As hard as we work in licensing other assets and commercializing those, the Feramax business has continued to grow. We've leaned into that. We did a reformulation with essentially a new platform technology in 2020. And then we essentially replaced existing products with new Feramax, and known as Feramax PD, a patented formulation. And then we relaunched Feramax 150. Feramax powder, as it was known, is now Feramax powder 15. I talked about launching Feramax 45, which I'll explain in a moment, and we have the next Feramax product that's in development. So it's essentially a wraparound life cycle strategy with the product, and it's intended to exploit opportunities in the market where we think the patient or the consumer is not well served, and we've developed these products through consultation with healthcare professionals and the extensive market research as well. So Feramax 45, what's it for? Is that just a different strength of Feramax? Well, obviously it is a different strength. It's 45 milligrams of elemental iron. It comes together with vitamin C and B12. It's a chewable product, which is very unique for iron. If you've ever had a need to take an iron product, you find it very metallic in taste. That would not be true of Feramax generally, which allows us to offer a chewable product. It's a great product. If you haven't come across it yet, check it out at your local pharmacy. It's available now in over 2,500 pharmacies in Canada. The purpose of Feramax is essentially to bridge the gap between the really low dose iron that's available in a multivitamin and therapeutic doses of iron, which you see in Feramax 150. So about 25% of people that are, and it's typically women, women consume over 80% of iron products in Canada. These women are repeatedly in a cycle of iron deficiency and iron deficient anemia. So this is proposed as a solution for doctors and those patients to maintain healthy iron levels after they've been on a course of therapy with Feramax. So it's been well received. Still early days. We're essentially 9 months into the program, but it's an outstanding product and quite unique in the market. I mentioned that we launched a new women's health product, started shipping in August. This is Inofolic. It's a new treatment option for women with polycystic ovarian syndrome, PCOS, as it's known as the acronym. This is, unless you're a woman, this is a condition that is not well known. In fact, it isn't well known amongst women and not that well understood by the healthcare profession either. It causes insulin resistance, infertility, menstrual dysfunction, skin issues, either dark skin patches or acne, unwanted hair, and like excess body hair, and in fact hair loss. So it is quite a concern for those women that have PCOS. Inofolic is not a cure for it. It can help manage the symptoms. And our product is a unique soft gel combination of myo-inositol. It's the compound together with folic acid, which is a better known material as well. So this product is even earlier days than the Feramax 45. The feedback that we've had from launch has been quite positive. But we're really, we're just kind of working with a small segment of the ultimate target audience there, just kind of working in the infertility sector before we expand that out beyond that group. And our last introduction for 2023 was Gelclair. This is a product that we licensed at the end of last year. It's probably the fastest we've taken a product from in-license to market. That's partly because it's regulated as a medical device, and the process to get a medical device approved in Canada is a little bit more streamlined. This is a product that is for oral mucositis. So this is a condition, a side effect essentially for cancer patients that are undergoing radiation therapy or chemotherapy. It occurs for head and neck cancer patients undergoing radiation therapy, virtually in 100% of patients, in chemo in probably 40% of patients, with varying degrees of severity. But when it does show up, it can be quite debilitating. It can prevent people from eating and drinking, speaking. It has a dramatic effect on quality of life. And in fact, as a result, patients often stop their therapy, which obviously when you have cancer is not ideal. So this is a gel that essentially coats the mouth and allows healing to occur. And it essentially provides relief very quickly. So we just started shipping that product in November, and we've already got some of the key cancer centers working with the product and trying it out with us select patient group. Excuse me. So that group of products, the Feramax line, together with Inofolic and Gelclair, and Tibella, which is the hormone replacement therapy that I mentioned before, that we launched the menopause.ca website for, is still in significant growth mode. So those together as a group essentially form our next 3 to 5 years of growth. And then we've got a few things coming in behind that, not yet transactions completed. The other thing that's a key part of our program is acquisition. We have not acquired anything. I'd say in the last 2.5 years or so, we've worked on 11 different acquisition opportunities. 3 or 4 of those where we went deep in terms of back and forth around valuation and but we haven't found something that kind of met our metrics from a business perspective and a valuation perspective. But that is a high priority for us to be working on this. So I mentioned earlier in the presentation, we have $29 million in cash as of September 30th. We have been returning capital to shareholders now for 5 years. I think that that number is about $18 million. We've paid $2.5 million of dividends. So we are returning capital to shareholders. We're in licensing products. We are investing in growing our revenue base. You can see that if you do a deep dive into our financials. You can see our OPEX has had a significant growth over the last few years, and that really is, 90% of that goes into commercialization of products. I should have turned that off. So I do get asked, and Paul, you're probably going to follow up with a question on that around, okay, so you've got $29 million of cash. What do you plan to do with it? So that, the first and best way to answer that is our cash is the purpose of the capital in the business is to support our strategy of growth and portfolio diversification. So we have launched 6 products in the last 3.5 years, 4 years, 6 products. Each of those products require investment upfront, or some investment upfront, investment to get them approved by Health Canada, pre-market or pre-launch investment for marketing research and other preparations. So we're investing in revenue growth, top priority. That's gets the first dollar, and diversifying the portfolio. Though we have been doing that, we are a cash-generating business. I mentioned that I got my number wrong before. We've returned $2.4 million through dividends, 17.2. That's to the end of December. $17.2 million in share buyback. So that has increased the earnings per share by reducing our share count by 21%. So a significant return of capital to shareholders. As part of our program, we're keeping some powder dry for deployment into acquisitions, because we do not need $29 million to operate a business. Just a quick look at the cap table, and I just want to point out or just underscore my point earlier about RSUs. So that share option number that you see on the screen has not changed now in almost 4 years. The RSUs kind of ebb and flow. We've now hit our first anniversary of vesting on RSUs, and so that number will be somewhat dynamic, but is fully supported with shares that we have. You can see here in this case that we've got over 200,000 shares in trust, and RSUs outstanding just under 200,000. And you can literally follow that along with the financials. That's what I've got for you, Paul.
Well, you sort of did my work for me. I've got a whole bunch of questions now that got check marks on that I don't need to ask. And the big one was the capital allocation. So you did a really good job. And I gotta say, like, we look at a lot of companies and very few have sort of the detail in terms of how you manage your sort of capital allocation, dividends, share buybacks, reinvestment in the company, obviously. And I love what you've done with the RSUs, by the way. I think more and more companies should look at that plan as a way to compensate management and board members. Listen, honestly, I sort of run out of questions other than to say, like, the business, it's a far cry from where we were when we first met a long time ago. You got a lot more cash to operate with. You got way more products. I remember the challenges back then, but what sort of challenges do you feel you face right now? What keeps you up at night, if anything?
Well, there's more complexity in the business. We are, multiple brands, and they're all at various stages in their life cycle. They all need care, feeding, and attention. And so we've got to orchestrate that. So it's not all the same people working on all of the same products. That's really how we've structured the business. So that's one. I would just say that kind of as the keeping the concert going and making sure the oboes and the violins are kind of working together, but doing their own thing, I think is one thing that would keep me up. I would say anytime you launch products, you want traction in the marketplace. And our experience just generally has been that the timelines, don't typically go as you expect. There's always some things that present themselves as obstacles 2 years or 3 years after you've kind of launched into a new therapeutic area or into a new product area that present themselves. So those are things that they're not the cause of sleepless nights, but I would say that is always a challenge in the business, is to build enough momentum in the new products.
Mm-hmm.
And then the fact is, we have a significant amount of cash on the balance sheet, and the kind of work to deploy that capital while still staying patient.
Mm-hmm.
That balance between patient and waiting for the right pitch, as it were, but also being cognizant of the fact that we are essentially overcapitalized. Mm-hmm. And so we acknowledge that, but we're not going to do a deal for the sake of a deal. So mm-hmm. It's maintaining the discipline on our licensing transactions and on acquisition assets. I think those are the things that they don't cause me sleepless nights, but yeah.
some nice problems to have. Yeah. So talking about that a little bit then, like what's the buying landscape like right now? I mean, the life science sector is somewhat, it's nowhere near where it was 2 years ago. There's less capital out there. There's a number of companies that are struggling. I mean, is the pipeline getting fuller because of that or not?
Yeah, that's a good question. So I think I'm going to break it into two different pipelines, right? So there's mm-hmm. acquisition and there's licensing. Mm-hmm. I'll tackle the licensing one first. We've got essentially, and you've heard me say this before, I'm sure, we've got as much licensing activity in our funnel as we've ever had. And in fact, we've just beefed up internally the manpower, the resourcing in licensing activity. So it looks like we've done a lot and we've got a lot on the go, but we're interested in more. When you are not other than Feramax, if you're not in developing products yourself, then that essentially is your lifeblood. You've got to be bringing new products into the business. Mm-hmm. And it allows us to think about growing and scaling our business without having necessarily to be thinking about geographical expansion. Mm. So we're a small business, $30 million in sales. There's a lot of opportunity. There's a lot of products out there. So licensing is an important part of our business, and we're not seeing any less opportunity. Mm. And pricing has been, I'll say, persistently rich. Mm. Probably a good way to describe it. I think, and so I don't think that's been affected by the economy. That's my view. Part of that is because who we're talking to are not, typically biotechs. So I'm thinking small development biotech shops. That's probably not who we're talking to, because they don't want to. They want to do a deal with somebody that's going to give them $100 million, right? Mm. Or buy them. Sure. So that's not really us. That's not the conversation we're having. Mm-hmm. We're talking to companies that they maybe are commercializing themselves in another market, mm-hmm. and are looking for an additional footprint in the Canadian market. Mm-hmm. And so in those scenarios, I don't think they're in any position because of the market or the economic activity that they're going to take a haircut for their licensing deal. On the acquisition side, I would say, there's distress companies in our area, have been distress companies. Part of that has been driven by the interest rate environment, mm-hmm. no question. I think there's some that have done a nice job of skating through issues. There's some in the Canadian landscape have kind of skated through issues, and in one case, one company basically was bought out because they had a wall of debt staring at them. Mm-hmm. So there's nothing there that in what you can see, which is the listed company landscape, where I'd say there may be more headaches that you would acquire than opportunity with some of them.
Mm-hmm.
The best ground for us for a new asset to acquire an asset would be larger pharmaceutical companies that are reshaping their own portfolio. So they're thinking about, do we still need that product, or could we use additional capital for this new development opportunity that we've got?
Mm-hmm.
And so that's our list of typical suspects. You're not going to find that by talking to the local subsidiary of multinationals,
Mm-hmm.
because the local managers, they don't want to give up any of the revenue or margin, right?
Right.
So now you're kind of essentially having that dialogue at the global scale, and a small deal for a Canadian asset is not always the highest priority for that group. So
Sure.
it's not like the volume of those opportunities is as great as the volume of in-licensing transactions. I would say we're probably, realistically, we're probably a 10 to 1, 12 to 1 in terms of volume.
Yeah.
And then when we've had meaningful conversations around assets that are available, and just to be clear, I'm talking about that are in market and already generating revenue in Canada.
Mm-hmm. Mm-hmm.
I have not found the valuations kind of coming down. Like I've found them, maybe it's got to do with the potential partner that we would acquire from and their financial position. These big multinationals that and they're, at least at this stage, I haven't seen anything on pricing that would suggest that there's distressed assets available.
Right.
Yeah.
Gotcha. Very good. Okay, let's talk about Feramax a little bit, because Feramax, obviously from early days that's changed quite a bit, but now, I mean, there's significantly more international sales. What more can you do sort of on the international front with Feramax?
Yeah, that business has been challenging for us. We have some partnerships outside of Canada.
Mm-hmm.
And it's really been hot and cold. We found it a challenge. I would say I wouldn't want the folks that are listening in and that are going to watch this later and think, oh yeah, there's a massive opportunity.
Mm-hmm.
I'd say we see some opportunities. Part of what we're doing around product innovation is to help give us some fuel to maybe break into some markets that we have not been able to do. So.
Mm-hmm.
We are developing those products for the Canadian market, and we have some expectation that we'll be able to find some new markets ex-Canada. But there are some, certain conditions in the iron therapy in Canada that make it a really good market for us with Feramax that don't necessarily exist in all other markets. Iron is regulated as a prescription medication in some places. We have it approved as a prescription medication in some markets, but the manufacturing standards, known as GMP, they vary, and so navigating that so that we can count on Feramax as a strategic pillar, I would slow go that. I'd tap the brake on it a little bit. We're going to be opportunistic with the brand. We are working on a couple of things, but they're not ready for prime time, and I couldn't tell you about them because then I'd have to kill you.
Exactly. We don't want that. I want to remind everybody that's listening, if you've got a question, and I know we've got a couple questions lined up here. If you've got a question for Rene that you'd like me to ask, just use the chat function and we'll do that. Rene, let's jump to one of the questions. Last time we spoke one of the projects that you were launching was the mixture of ibuprofen, acetaminophen. The question that came in here says that somebody just saw that Advil's launched a similar product. Can you touch on that? Maybe touch on a little bit of the product and what's the competitive landscape look like?
Yeah. Combogesic is the product. It's got acetaminophen and ibuprofen in a unique formulation ratio. A really excellent product. I don't know if you've had a chance to try it. I continually get feedback from folks that have used the product, and it seems to be able to address mild to moderate pain. So we have a label, which is a little bit kind of inside the beltway speak, but our label, our indication is for moderate pain, whereas those two big, the acetaminophen brand and the ibuprofen brand, I guess you named them Advil, so I can speak about that. They're not indicated for moderate pain. So Combogesic is indicated for moderate pain, which, you know, there is actually a scale on how pain is measured in so you know, it would be a great option for a product before somebody would get started on the lower strength of the it is not done as well as we anticipated around our pre-launch diligence and the market research that we did with healthcare professionals. Those brands that existed in the marketplace are big spenders and deeply entrenched, and we have not had the impact on the market that we would have expected at this stage. Advil did launch a product that was not it was not visible to us that was on the way. Normally, these things you can kind of, they're somewhat telegraphed and you can see them coming. Their product has done better than Combogesic, but relatively for the company that sells that product, it hasn't been terribly successful either. I think Combogesic is going to be one of those kind of slow burn over a long period of time products. So we're just managing it in the marketplace to make sure that we give it the appropriate amount of promotional weight amongst all of the other growth assets that we have in the business.
Rene, of all the things you've got, all the initiatives that you've got going on right now, product or just sort of business initiatives, what are you the most excited about right now?
Oh, well, I'm excited about the Feramax life cycle strategy. I think there's one of the reasons for that is we own the brand. Whereas, you know, I made reference, for example, before that we extended the licensing arrangement on Cathogel. So on the other assets, you know, they've got a long life. I mean, we do long-term deals. We don't do 2-3 year deals. These are typically 8, 10, 12-year deals. But we own the Feramax brand. So there's a tremendous amount of value in our company around the Feramax brand, and I'm excited by what we're doing with that. We've got something that we're working on right now, a new product it's been developed. It's a new in-licensing project, and essentially we need some indication from Health Canada that our regulatory strategy is going to sync up with them, and that one's got me really excited.
And when do you think we might hear more about that?
Probably in the second quarter.
Okay, fantastic.
Yeah, and probably if it gets kind of past that hurdle, you'll probably just hear about it as a licensing transaction. We won't get into any specifics about the product.
Okay. Yeah. So if we see something announced in Q2, we know that that's likely the one you're excited about. You might not say that in the press release, but we'll know that. That's good. That's good. Yeah. This is helpful. Listen, before we sort of wrap up here, what, you know, as investors, we're watching the business now. What do you think are the most important things that we really have to pay attention to make sure that we sort of understand you're sort of hitting your milestones or executing?
Well, we need to continue to generate growth out of the existing portfolio, and that portfolio has just recently grown. So we've got a number of growth assets that I've talked about. So essentially look for us to be generating significant sales growth, and we expect to continue to be investing on these growth assets. So our ratio of profitability to revenue has been impacted over the last couple of years. We've had tremendous individual quarter profit periods, but I would say we're investing in launching all these products, and that takes a fair bit of OpEx. By the way, that's not messaging that we're not going to be profitable. It's just that we've been known as a really high margin, high operating margin business. I would be looking for us to, over time, and I'm not talking quarters, I'm talking over the next 2 years, to move that profitability higher over time. I would be looking for that as well. But we're, I talked earlier, we think our portfolio supports 60 million. And so, that's not around the corner. We think we've got a lot to work on and grow the existing assets. And then I'd be looking for us talking about new assets coming into the portfolio.
That's awesome. We certainly appreciate the update, and it's been far too long, so we got to do this on a more regular basis. But before we go, is there any key message, or what's the key thing you want to make sure that everybody walks away with today?
I think in my comments just now, just a moment ago, I think that pulls it together. I think what we're doing is somewhat underappreciated. I would say that's, every CEO you talk to is complaining about their share price. I'm not. It offers us an opportunity to continue to buy shares in the market under our NCIB. So I don't want to be the one that's going to sound like they're complaining about their share price. I'm in the short term indifferent to it. But recognize that that folks invest in us and they expect over time to have appreciation of the capital, and then look for us to continue to return money to shareholders, whether that's NCIB or.
Yeah, well, I mean, listen, as I said earlier, I think you belong in the Canadian Microcap Hall of Fame as a manager. I think you've done a spectacular job of managing, a very, very small business into at least a slightly larger business, and I think you're doing a great job in terms of capital market strategy. Love the fact that you're a little indifferent to the share price because you can take advantage of it. And maybe before we sort of really wrap up, I mean, you talked a little bit about share price. What sort of interest are you getting from investors, whether it's institutional investors or whatnot? Are you hearing the phone ring right now? You're still, a microcap in the Canadian sense.
Yeah.
Are people calling you?
Yeah. I guess in Canada, we're a small cap because the microcap terminology is not quite as widely kind of bandied about.
Yeah.
I would say we get some calls. Yeah. We get two types of calls. I mean, one is investors wanting to kind of, we've showed up on their screen. They want to know a little bit more. We get strategic interest as well. So, that phone rings there as well. We've had that type of foray from European, American, and Canadian actors. I think we're less institutionally owned now than we were 4 years ago. We had quite a number of institutional owners, and then in that first kind of COVID wave, the very first investor panic, we had a number that basically sold down their position or sold out of their position starting then. And I would say we're held a little bit more by sophisticated retail investors, as I describe it. We don't have a lot of bandwagon jumpers. You see it. There's been that move at the end of last year. I guess Chairman Powell got the show going, and then everybody jumped on and they got all excited. Obviously, we had good business results, and there was a little bit more interest in microcap, small cap. We benefited from that, I would say. But I for the most part, I see pretty long-term investors, which I think the sophisticated retail investor is probably more long-term investor than the institutions. Sometimes I'm not convinced the institutions are as long-term as they might.
As they claim, I know.
Well, now, having said that, we have institutional investors, particularly in the States, that have been with us a long time. So I want to be clear. I'm not denigrating that, but I'm just, I've had plenty of experiences with, hi, how are you? Yeah, we're owners. And then the next time I see them at a conference or something, I guess that depends somewhat on liquidity. It's difficult. I mean, we've had more volume of late, generally, not huge volume, but more over the last couple months. But you know, it's hard for an institutional owner.
Yeah. No, understood. Perfect. Well, listen, thank you so much for joining us today. We've been speaking with Rene Goehrum, CEO of BioSyent. Symbol is RX on the Venture Exchange, and BIOYF down in the States. Rene, it's always great to catch up. Appreciate the time, and look forward to the next time we get to chat.
Great. Thanks, Paul.